If you've been told you can't qualify for a mortgage because you're self-employed or you can't qualify for as much as you need, then you're going to want to watch this video. Here's why. I recently closed on a loan for a client whose tax returns showed him making $3,000 a month. His bank statement showed him making $38,000 a month. Same man, same business. One number almost cost him his dream home. The other handed him his keys. I'm Rebecca Foote of the Rebecca Foote Mortgage Team, and today I'm going to show you the full roadmap for using bank statement loans to purchase your next home. You'll learn what they are, how to qualify, and how to use them to buy your dream home or even an investment property. So let's get into it. Here's the situation I see all the time. You're a business owner. You work hard. You've built something special and you're really good at it. And you have an amazing accountant, one who knows how to legally minimize what you owe at tax time by maximizing your write-offs and your deductions. That's smart, and that's exactly what you should be doing. But here's the problem. When it comes to buying a home or refinancing a traditional mortgage, lenders only count the income that you actually pay taxes on. So if your accountant did their job really well and your tax returns show modest income after deductions, that's all that the bank is going to see, not the gross revenue, not what's actually flowing through your business, just that taxable bottom line. So you got this frustrating situation where the very thing that saves you money at tax time is the very thing that's limiting your borrowing power. That's where the bank statement loan comes in. I recently closed on a bank statement loan for a business owner who owns a construction company. He always showed really good income until this most recent tax year. For this business owner, it was just really bad timing. You see, in November and December, he ended up paying a lot of vendors and other accounts payable that he did owe for jobs that he did complete. But he did not receive his accounts receivable in the same fiscal year. Come January, the people he did work for paid him. The problem? It made his last year's tax returns look like he didn't make any money. But if you look at his bank statements, he made plenty of money. On paper, with a conventional loan, I could only use his W-2 income, which was $3,000 a month. But by using his bank statements to qualify him, I was able to use income of $38,000 a month. I don't think I even need to say it, but it made a huge difference between him buying his dream home and not. So Rebecca, what exactly is a bank statement loan? A bank statement loan is a non-QM loan, which means non-qualified mortgage. In easy to understand words, it just means that the loan doesn't follow the traditional Fannie Mae and Freddie Mac income guidelines. Instead of looking at your tax returns to verify your income, the lender looks at your actual bank statements. We're looking at the real deposits, the real cash flow, what's actually happening in your bank account. And that's a much more accurate picture of what your business is actually doing. This program was designed specifically for people like you, business owners, freelancers, consultants, anyone whose income doesn't fit neatly into that W-2 box. Here's how it works. We pull either 12 or 24 months of bank statements. This could be business or personal accounts depending on how your business is structured. If you're a sole proprietor, we can use your personal bank statements. If you have a formal business entity like an LLC, S Corp, C Corp, or a partnership, we're going to use your business bank statements. Showing 24 months of bank statements is even better than 12 because it shows more consistency and stability in your income. But 12 months is the minimum. Now let's say we're using business bank statements. Once we have those statements, we add up all the deposits. Then we apply what's called the expense factor ratio. The standard is 50%, meaning that we assume that half of what comes in to the business is going back out to pay business expenses, and the other half is your qualifying income. So if $20,000 a month is being deposited into your account, we'll use $10,000 for your qualifying income. Here's the good news. If your actual expenses are lower than 50%, we can reduce that ratio. We can go as low as 25%, but we do need a CPA letter verifying it. That letter from your accountant simply states what your actual expense percentage is. And trust me, going from 50% to a 25% expense ratio makes a big difference in what you qualify for. Now let's say we're using personal bank statements. We add up all your deposits and we use that amount for your income. So if $10,000 a month is being deposited, we use $10,000 as your qualifying monthly income. However, if we notice a reoccurring expense leaving that bank account every single month, we will subtract that from your income. Everything else on your loan, your assets, your credit, your liabilities, is all documented the same way it would be with any other mortgage. The biggest benefit is obvious. You qualify based on your actual cash flow, not your taxed income. That means you might qualify for significantly more house than a traditional loan ever would allow. And if you have strong, consistent deposits over the past year or two, this loan can be a real powerful tool. Now, you do need to have been in business for at least 2 years. There are some cases where we can get an exception if you have been in business for 1 year or more, but were in the same line of work prior to opening or purchasing your business. Also, you can use a bank statement loan to purchase an investment property. And if that's the case, you are allowed to take title in the name of an entity. If you're buying an investment property and you want to settle in an LLC, you can. We currently lend in 9 states: Pennsylvania, Maryland, Virginia, North and South Carolina, Florida, Alabama, Texas, and Colorado. And the list is always growing. So if you're watching from one of those states, we can absolutely help you. And if you're in a different state, still check with us. We may be licensed in your state by now. Quick thing before we move on. If you're already wondering what your bank statements would qualify you for, that's the easiest part to find out. Send me 12 months bank statements and I'll calculate your number, usually within 1 business day. The link is right below this video. There's no cost and no pressure. And if you're enjoying this video and have already learned something new, please do me a favor and hit the like button. It helps me to keep putting this video out to other business owners who would appreciate knowing these loans exist. Now, I always want to give you the full picture, so let's talk about the trade-offs. First, interest rates. They're typically 0.5% to 1% higher than that of a conventional loan. That's the cost of flexibility. It's not ideal, but for many borrowers, it's absolutely worth it. Next is credit score. You're going to want to have at least a 620 credit score, ideally 740 or above, and that's going to get you the best pricing. If you're working on your credit, let's talk. There may be things that we can do to get you there. And here's the best part of the non-QM loan. Say 2 borrowers are buying together. Borrower A has a 750 credit score and borrower B has a 630. On a normal conventional loan, you would have to use the lower of the two, the 630. But a bank statement loan, we use the higher of the two, the 750. And that saves you real money. Next is reserves. This is a big one. After closing, lenders typically want to see 3 months of mortgage payments still sitting in your bank account. Some investors go as high as 12 months. So don't drain your accounts to close. You do need a cushion. Down payment. Plan for 10% down. Some programs require 20% down for certain credit profiles, but 20% down is the starting point. Debt to income ratio. On a conventional loan, lenders might allow you to go up to 45 or 50% debt to income. With a bank statement loan, most programs cap you at 43%, but we can go up to 55% debt to income. Loan types. You'll see more adjustable rate options or ARMs in this space than that of conventional loans, but we also offer a 30-year and a 40-year fixed rate mortgage. Here's the bottom line. If you're self-employed and you've been frustrated by the traditional mortgage process, a bank statement loan might just be your answer. We've been helping business owners get into homes for over 20 years, and we love finding creative solutions that actually work for you and how you live and run your business. If you want to find out if you qualify, I want to hear from you. You can schedule a call with me directly. The link is right below this video. We'll go through your situation together and find the best path forward. Thanks so much for watching. If you found this helpful, please give us a like and subscribe. I put out new content every week on loan types, mortgage education, and tips for people just like you. I'll see you in the next one.